The disclaimer, I do need to mention it. Obviously, we mention a lot of stocks in this presentation because we do own quite a few little interesting stocks. But at the end of the day, please do your own homework. Don't rely on what's in this presentation, and it's all very much general advice only. So I've been at NAOS now for over 11 years. We started with roughly about $6 million in funds under management and had about, maybe we might have had 20 investors if we were lucky. Today, pleasingly, we launched our first LIC NCC about 6.5 years ago and raised 17 million, and I struggled to get 400 shareholders, and then today we have about 8,000 shareholders and we run about $300 million across 3 LICs, although with very much a small cap, as you would know, small cap, micro cap, industrial focus. They're all very much true to label, and we have very much a stringent ESG framework over that as well. I think the thing that sets us apart is that we're very aligned with our shareholders. So all of my funds is invested in the 3 LICs. I don't have any shares outside of our LICs, and family and friends make up the largest shareholders in all of the LICs. So we're very much aligned with, hopefully all of our shareholders. We've added 2 words to this title, the words being obviously competitive advantage. I know many fund managers will obviously present and obviously profess to have a competitive advantage. We may value stocks differently or have a different thematic process. But in my view, these are probably the 8 key points that really do set NAOS apart and really do give us a competitive advantage over the longer term. So I know people like to pigeonhole us as either a value manager or a growth manager. I know it's very topical these days with growth been in vogue now for so long. At the end of the day, we invest in businesses that represent value today, but we want them to grow over the longer term. So they may not be growing today, but we expect them to grow over a 3 or 5 year period. So they may not be growth stocks or value, it's really a mix of both. As I get reminded many times, yes, we have very concentrated portfolios, so we believe in quality over quantity. Big believers that it's very hard to find quality businesses in the ASX, so when you have them, you should hold them in a reasonable way or have a reasonable weighting, hence why most of our funds only have 10 or 11 positions in each. They are highly concentrated funds. We invest for the long term. So a good example of this is a Nero, for those of you who are an NCC shareholder. Nero's been in that fund for over 6.5 years almost. So very hard to find a fund manager that can find a position like that, build a sizable stake and own it for such a period of time. And pleasingly for that position at least, it's starting to bear some fruit over the past 4 or 5 months. We don't invest in liquid stocks. Clearly they're very illiquid stocks, and I use the analogy that for all of you that don't know, the ASX 200, if to get into the ASX 200, it's actually based on liquidity. It's not based on the size of a business. A lot of people actually don't realise this. So I use the example that Reece Plumbing, for all of you who are looking for new toilets and basins, that business is capped at probably $3 or $4 billion, but it's not even in the ASX 300. And the reason being is because the founding shareholders, the Wilson family, have a 60% stake in that business, so it doesn't have the liquidity requirements to get into the ASX 300. In our view, a very high quality business, a business that you want to own, and just because it's not in the index doesn't mean that we shouldn't own it. And that's sort of the view we take across all of our investments as well. We don't follow an index. Clearly that hurt us last year. We only invest in industrials, so unfortunately for those of you who do mining and early stage technology, we leave that to you. We try to focus on what we believe we can do best. We have a very stringent ESG process because we believe it's very much beneficial for the business over the longer term from a number of perspectives. And management alignment's key. I think it's very important. I'm a big believer that investing in businesses, especially some of these smaller businesses, a lot of it relates on, I know people may not appreciate it, but on trust and transparency. Numbers unfortunately come and go and they're very rubbery. So you really need to find management teams and directors and employees who are very much aligned with all shareholders. That's the best form of alignment that you can have. And that's how we treat our own shareholders, and that's how we treat our own investments. Most of our investee companies are actually founder-led. They started these businesses. They're not an executive who's been there for a couple of years and then plans on leaving in 12 months' time. So reasons not to invest in NAOS, and this really just hits the nail on the head on why we are different and what you need to consider before you do invest in or even consider investing in a NAOS fund. We are long-term managers, so if your time frame for an investment is less than 5 years, this fund's not for you or any of the funds under the NAOS stable. As you can tell, index returns and NAOS returns can differ significantly as they did last year. Clearly, we underperformed significantly last year. We've gone through periods where we can outperform significantly. I've always said NAOS funds should do better when the indexes tend to meander sideways or even in a slight downtrend. When it's a raging bull market, we will always underperform because it's not the type of the investments that we tend to make, unfortunately. If you want to invest in more larger and more liquid businesses, you should look elsewhere. And the big one is obviously if you don't like the LIC structure due to obviously premiums and discounts, it's been very topical in the past 12 months. That's something else that you should consider as well. I've gone through now, unfortunately, started it at a big discount in NCC, got it to a big premium, and now we're going the other way again. So I've seen the highs and lows and everything in between. And I know it can be quite a topical subject for people, but it is something they do need to consider. So I do believe it actually has a number of big advantages for us when we invest in small businesses. And obviously, if you're uncomfortable with concentrated portfolios, our businesses can do very little for a long time. If we had 80 or 70 investments, we can talk about all sorts of things, but unfortunately, that makes it only a very small part of the portfolio. So when you have 10 stocks, it can be quiet for a long period of time. Touching on FY19 before I touch on reporting season and how we're invested currently, I think it's very important for the investment team and us as a business to really understand why we underperformed in FY19. Clearly, we don't hide from that fact. And these are the 5 key points that we really came up with that probably influenced our returns, albeit they weren't directly responsible for the stock-specific investment decisions. The key point, and this is a point from all financial years that NAOS has been through, is a lot of these small businesses, they just took a lot longer to execute. If anyone's run a small business, I can tell you by running this small business, everything takes longer. Unfortunately, if you're delayed by a year, that means your profits at the end of that are going to be delayed by 2 or 3 years. What that means for a share price is, well, it's going to be ultimately delayed, or any appreciation or depreciation will be delayed for a long period of time. And I think we saw that in FY19. Some great examples were M&F, BSA was probably a standout that was very much delayed. But pleasingly, in reporting season in August, some of those managed to make up for some lost time. But it can affect our performance in the short term. PE compression, so what people are willing to pay for a business, another one that probably doesn't get talked about too much. I use the example in this case that we had an investment in, when we inherited NSC, we kept an investment in Motorcycle Holdings, so Australia's largest dealership of motorbikes or motorcycles. So 3 years ago, you could have paid almost 20 times its earnings for that business. 3 months ago, you could have paid about 10 times or 9 times even, depending on what you thought the earnings were going to be. Earnings in small companies, they are more volatile, but you've seen the PE compression has been significant, and it's been not harsh is the wrong word, but it's happened in a very short space of time, and we saw that across a lot of our businesses. What people were willing to pay for small businesses, especially small industrials, came off at a rate of knots, and it affected share prices in the short term. We had a few stock-specific catalysts. I had a lady in I think it was in Brisbane the other day talking about one of our investments, and she's saying, well, what are they doing about trying to get the market to understand about what they do, or why they're an exciting investment. As you know, with some of our investments, the people who run these businesses are good at running businesses. Sometimes they're not very good at running listed businesses. So when it comes to investor communications, presentations, and keeping the market informed, sometimes they're a little bit behind the 8 ball. And that means obviously when you have few stock-specific catalysts, we do go through periods where it can be a little bit quiet and performance can meander. Having a concentrated fund that doesn't adhere to the index. Clearly, when the Afterpays and the WiseTechs of the world that it's formed such a large part of the Small Ordinaries Index perform like they have, it makes us very vulnerable, and when our investments don't perform as expected, clearly the underperformance can be significant, as was the case in FY19. And then the 5th point, which I think is worth talking about, small cap fund managers in Australia, they were going out the back door at a rate of knots in FY19, unfortunately. We've had a lot of people come into the space, I would say over the past 4 or 5 years, want to get into micro cap investing, small cap investing, and clearly like us, more recently probably they've underperformed. And what's that meant for some of them is, because some of their shareholders and larger investors have pulled their money out, it's forced them to close the doors and redeem all their funds. So what that means for us is that they have to sell their investments, sometimes we'll share an investment, and that puts short-term downward pressure on some of those stocks. but we would say almost 8 to 9 small cap fund managers have probably ceased to exist over FY19, so it is a real occurrence. Our financial year returns. The 2 points I want to get across here is the first is it was really a NAOS philosophy and investment process issue, I think, in FY19 that clearly was the issue, because you can see all 3 of our funds produced a negative return. It wasn't a stock-specific issue, it was the core philosophy of NAOS that really didn't perform in these specific macro environments. In saying that, you can see every year prior to that we've produced a positive return. So we believe it's a blip, and pleasingly in FY20, even though we're only 2 months in, you've seen our returns have been clearly much improved, I would say. And thankfully in September they continue to improve again. So we feel like we've definitely hit some momentum. Our core positions, for those of you who've known, have definitely reported well, most of them, and hopefully that continues for the rest of FY20. Looking at FY19 and just the market backdrop, I tend to prefer to talk about stocks as opposed to the market, but I'll do a little piece on the market. A few points that really came across was that throughout FY19, expectations were revised down from the start of the year all the way to the end, and that started the same way this year, unfortunately. Dividend payout ratios. Everyone likes a dividend in Australia, especially all the SMSF holders. And even though earnings from businesses were flat, dividend payout ratios actually went up. And I think that's interesting because it shows you businesses and boards or management teams aren't willing to invest. They're not willing to make acquisitions. They prefer to pay a larger portion of their earnings out as dividends, as opposed to probably making some longer, harder decisions for the long-term benefit of the business. We did see some fatigue in some of these high growth names. I know someone mentioned Audinate before. Clearly you would call that a high growth business that's been a stellar performer, one that's continued to perform very well. But then on the other side, we've seen some of these higher growth businesses such as Nearmat, for example, that started to go the other way. You're starting to see now some of the ones that the market truly believes has a strong competitive advantage and will last for a number of years. And then you've seen the market become a little bit more sceptical on some of these maybe one product businesses, saying, well, maybe this doesn't have the longevity and the competitive advantage that we originally thought. The macroeconomic environment, everyone talks about it. Interest rates, trade wars, it did dictate the performance of some businesses. And I'll give you an example a couple of slides after this. It was a very real issue that we were faced with in the short term. And then buybacks. Clearly, we've started a couple of buybacks, and a few businesses in the ASX 100 have done as well, with over $2 billion worth of buybacks. So between buybacks and dividends, companies are returning a lot of money to shareholders as opposed to making new investments. This just gives you a chart of earnings expectations for FY19 and FY20, and as you can see, it tends to be human nature. Everyone starts very positive in the year, and as the year goes on, unfortunately, it became more and more negative, with earnings just finishing up 4.6% for the year. And it looks like in FY20 it started the same way. People spoke about an election bounce, which we had, but it felt like that election bounce came off rather quickly. But as we will speak about later in the pack, we feel like there are definitely some green shoots from some of those more consumer-related businesses. I saw a note this morning on Kathmandu, for example, another consumer-related stock that actually reported quite well and is actually quite upbeat about the future. So it's very much a choppy market, and you have to be very selective where you're investing in regards to those macroeconomic headwinds. To give an example of this, 12 months ago I was speaking about some of the building-related businesses in regards to infrastructure. Hopefully you didn't listen to me too much, because you can see by some of these businesses, it was a very poor year for building-related businesses. So people would think, with all the new toll roads that are coming in, the new airport in Sydney, the infrastructure spend in Victoria and now even Queensland, some of these businesses would benefit. What we've seen though is the delays in some of this infrastructure spend. New apartment buildings have come off at a rate of knots, and they've almost been left with a bit of a gap, and on top of that, probably a lot of price increases in regards to employee costs and whatnot. So if you're a shareholder in Wagners, for example, or Adelaide Brighton, you've lost 59% and 42% respectively of your capital before dividends. On the other, and in saying that, these are some businesses that have been around for decades. I saw there's been a lot of talk about Boral, obviously, and corporate activity there, but that's a business that was down, share price terms, was down 22% last year. And a business that's been around for many, many, many years that many of you would know. And I would argue that the industry backdrop is still probably rather optimistic and positive for some of these businesses, albeit in the short term, the market's punished all of these businesses significantly. The opposite of that is if you've been long real estate, you've done well. So REITs, unfortunately, were up 14% for the year, and really again driven by lower interest rates. So lower interest rates leads to lower cap rates, leads to people looking for more dividends and higher asset prices. Just gives you some of the flavour of where people are investing. Clearly people who know our investment style know we're not a REIT investor. Clearly our investment style is more industrial based, so if you're in any of these businesses, it's proven to be a very difficult financial year. Just trying to look forward on how we're managing our portfolios, or try to look forward into the future. And clearly we run a concentrated portfolio, so everyone's always asking me and the team, well, how do you mitigate your risk against stock-specific issues? Clearly we're not going to get everything right, but I think there's a number of, I suppose, key points that you can implement to try and minimise your stock-specific risks. So people would know we invest in businesses that tend not to be very geared, so they can get through a bad period. We try to invest in businesses in this case that in industries that are growing. I think I've made the mistake before that you invest in a value business that's in an industry that's going backwards, even at a small pace, and it always ends in tears. I used the example a few days ago that anyone seen radio data for all the listeners of radio. Unfortunately, it was down another 1.8% year on year, the advertising spend in radio. Radio has been very resilient for a long time, but it does seem like it's death by 1,000 cuts. And even though some of these businesses may represent value, it does mean the pie is getting smaller. So everyone's fighting very hard for a smaller piece of revenue. In saying that, we think there are three areas where you can still invest where the pie is definitely getting bigger, and these are the three that I'll speak to. The one no one likes talking about, the ageing population in Australia. There are 4 points that we'll touch on here, and the first one is I will happily say we were an investor in an aged care business a couple of years ago. Happily say we got very burnt because we didn't see the Royal Commission coming. But in saying that, the Royal Commission is due to end in the next 6 to 12 months. And we do, as we said a few years ago, we do believe the aged care industry has to go through some radical change. If you just look at the baby boomers alone, the amount of people who are going to be over 65 or even 70 in the next 5 to 10 years, it's a significant amount of people. You're talking about millions of people, and we simply don't have the resources, let alone the funding structure to cope with such a change and really provide a service that these baby boomers are after. So we think, will it be the listed players or the non-for-profit players? Someone will have to benefit and someone will have to step up and provide the service that these people require. But unfortunately, someone's going to have to pay for it, and no one's too sure yet who's willing to pay for it, whether it's the government or whether people are willing to pay out of pocket. One that doesn't get a lot of talk anymore, but I did notice was in the paper this morning, was the NDIS. So for any of you who have any understanding of how the NDIS works, provides a lot of one-on-one care for people who need it the most. What that means is you need people who have been trained appropriately to provide that one-on-one care, which is no easy feat. And once again, it's very hard to get that sort of exposure in the listed space, but as you can see by the numbers below, there's over 300,000 people now who are on NDIS. So if you can find a way to get exposure to that thematic, that is a thematic that will continue to grow into the future. Another point that people probably doesn't get a lot of talk but is for any of you who have private health insurance, unfortunately, like me, feel like you don't get too much of a return. Hospitals, insurers, they want you out of the hospital as quick as possible, obviously to reduce their costs. The best way to do that is through better technology, better treating methods, and obviously better ways to treat you at home. What that means is they need better access to new technologies, newer drugs, things like that. And that's a way of keeping their costs down and obviously the burden out of the healthcare system. But if you can find a way, we have an investment in a business called BTC Health. It's a very small business in NCC, but looking to play off that thematic. If any of you know a business called Device Technologies, it was a New Zealand business, and here in Australia it was taken over by private equity for almost, I think, a couple of $1 billion, playing off that thematic, but only in a small place. So even like robotics and how they can fit into a hospital theme and improve efficiencies and improve better level of care. And the fourth point, and one that seems very simple, but I think people, again, don't talk about it enough, is there are some great unlisted businesses out there that have been run by baby boomers, for example, that simply don't have an exit strategy. I'm sure there might be a couple in here They've created a business over many, many years that would earn, 5, 10, 15, $20 million in earnings. And it gets to the point where obviously the founder of that business either doesn't want to work in it anymore, chances are the kids may or may not be interested, or even worse, one kid wants to do it and the other kid doesn't want to do it, and it turns into a bit of a family feud, so it's best just to sell. Obviously though, when you're looking to sell a business like this, you really have two options, and it's either to a larger unlisted business, of which there aren't too many. You can sell to a listed business. In our case, we're seeing a lot of our investments look at this because they've got the access to capital. Or your third point is you can sell to private equity. But in this case, we think there's a lot of opportunity for some of our businesses. For anyone that knows, obviously, Big River, our understanding of the building distribution industry is there's some huge businesses out there that are family run and family owned, but they simply don't have any exit strategy. So we think for some of our players, listed players anyway, there's a lot of opportunity for them to grow inorganically as well as organically. Cyclical businesses. Clearly, we've gone through reporting season. We've seen a myriad of businesses of all shapes and sizes. But a lot of people went into FY19 reporting season thinking that consumer was very much down and out. You still see a lot of press about it. But it almost hasn't been the case where expectations were just so low that now it seems like there's a bit of mean reversion and people feel like some of these businesses probably represent value. And the consumer isn't as bad as what people think. It's very much a confidence thing, probably a bit like funds management businesses. But what you did see is, an example, as I spoke to before, but motorcycle holdings. New motorcycle sales have been negative for 2 years in a row. July, August have been the first 2 positive months in the last 24. And I can probably almost guarantee you there's nothing more consumer discretion than people buying a motorcycle. What we think leads to that is obviously if you look at auction clearance rates in Sydney, for example, everyone's very interested in those. People feel a bit wealthier because obviously they feel like auction clearance rates are up. They feel like their house is worth a bit more, gives them a bit more confidence. Tax cuts are being implemented over the next few months, although it won't be today, but over the next few months that will be a beneficiary or a benefit to retail facing stocks. And as I said, a lot of feedback that we had from people that you wouldn't expect it is it definitely has been more upbeat. Even in the building space, as another example, yes, apartment buildings are off, but there definitely feels like there's a lot of work around in the commercial space, even the infrastructure space, as I've mentioned before. I don't think people are shooting the lights out, but it doesn't feel like earnings are going backwards at a rate of knots either. And the last one there is, there's been a lot of talk about the government and the government willing to spend. Clearly interest rates have come down. They've had 50 basis points. That does help some people, assuming they don't save it. But on top of that, if the government does spend, they've obviously spent a lot on infrastructure, if they can find other ways to spend and stimulate the economy, we feel that gives you 3 sort of strong tailwinds that will protect the consumer and probably protect earnings for certain industrial companies in the short term. The last one I'll touch on is infrastructure and the maintenance spend. I've spoken about infrastructure a bit, and I think we've very much come to the reality that anyone who's building infrastructure tends not to make an awful lot of money. It's the people who maintain the infrastructure that's where all the money is. Some of these contracts, if you're building a toll road or an airport or a hospital for that matter, these assets will be around for decades, and they need to be maintained by businesses that can maintain them, that have the workforce to maintain them. Everyone thinks, anyone can maintain them. But at the end of the day, if I'm a YMCA, for example, I've got properties all over Australia. If I could find a service provider who's got a national workforce who can maintain my air conditioning, my heating, my electrical, whatever it is, my plumbing, and I can do it through one provider, then that's pretty compelling. It's not as easy as just sort of looking in the yellow pages or Googling someone saying just fix my electrical issues at my site. And we think there's a lot of businesses out there that can get a hold of this pie because it is a pie that's getting bigger and bigger and bigger. And also the last chart there that we've put in is defence spend in this country. People speak about infrastructure, but if you look at the defence spend in this country, it's going to 2% of GDP. It's going to be over $44 billion a year. Now, clearly, we don't invest in businesses that make weapons and armaments, but there are businesses out there that if you look at defence, and even if you look at like their IT systems as an example, without saying what the company is, there's a company out there that provides a document storage solution that allows people who work in defence not to tamper with the document, but they can get visual access to it, and then it goes in the right place so people can get an access to see well, what documents have been used, who used them, for example, and who has permission to access them. If Defence is spending more and more money, then they need to spend more and more money on software to make sure that they're up with the times, as an example. Now, Rob's going to touch on all three of the funds, as well as a little bit of an outlook, and I'll be back to finish up and take questions.
Good morning, ladies and gentlemen. Thanks very much for coming along today and showing your support to our little business. We very much appreciate that. For those I haven't met before, I'm Rob Miller. I work at NAOS on the investment side with Sebastian for the best part of the last decade. We've just gone through a reporting season, which is obviously a great time to give you an update, because we get pretty much a look through on all the companies that we hold. They all update the market with their results, and we're able to provide you with the most up-to-date information we can. So high level, if I could summarise our reporting season in kind of one sentence, I'd say FY19, yes, it was a tough year for us, but the expectations on the companies that we held going into reporting season, in our opinion, were simply too low. And the subsequent result of that was an uplift into FY20, which we've seen in a lot of our companies and subsequently in the performance of our LICs as well. So yes, FY19 was tough, but we were able to buy more of our core holdings at lower prices, at compelling value, and that should benefit us all as shareholders. Touching on NCC first, which is our true to label micro-cap business there with a market cap of 87 odd mil, which is the average there. This is our oldest LIC, been around since February 2013, and I guess what's pleasing is often when people think of micro-cap companies, you don't often think of dividends, yet we've been able to prove that since February 2013 onwards, we've been able to pay a growing stream of dividends, franked to the maximum extent possible, which has been fully franked since that date, which is very pleasing for all the shareholders. I would also like to point out that the cash weighting has historically been quite low in this business. We feel that there's opportunities out there that justify that low level of cash. If we can't find that across all our LICs, we can hold up to 100% cash, but at the moment we're very happy with where it is. And finally there, just on the far right with the dividend reserve. So we're one of the very few LICs out there that actually publish our reserves balance on a semi-annual basis at these roadshows. And what that essentially justifies and shows to the market is that we're able to, if we were no longer to perform as of today onwards for approximately 2.5 years, we'd be able to maintain the current dividend stream. We'd be able to maintain that, and subsequently franking credits on top are a separate issue, which we would have to generate franking credits. But effectively, we've got enough profits within the vehicle to pay a steady stream of dividends for 2.5 years at the moment. Now, coming on to some of the core holdings, we often talk about these businesses, so I'll try and be relatively quick here, but start with BSA, which is a field services business. And if you've been to one of our roadshows before, particularly in the last 6 to 12 months, you would have seen us talking about BSA and the fact that there's a legacy issue within that business that was causing a lot of downturn on the share price and a lot of loss-making, there was no profit there for the business. Pleasingly, we can sit here today and say that that has been eradicated and resolved from the business, hence why we've seen a re-rate subsequently into FY20 and beyond. So why we like that business from here going forward, they're a key beneficiary of the NBN. And when you think of NBN, you don't often think of beneficiaries because it has been an absolute disaster. But these guys do a lot of the maintenance and the connections for the NBN. And going forward, the NBN is not a static beast. For whatever reason, with the technology mix, with what it is at the moment, it's going to need constant upgrading and constant maintenance. And BSA are a key beneficiary of that, as I suggested. Furthermore, they do a lot of maintenance work for a lot of nationwide operations in terms of the YMCA, as an example, and they do a lot of tunnel work. So any sort of infrastructure work in the fire space, these guys are a key beneficiary there. BTC Health, this is a relatively new one that we haven't talked about too much in the past, but to quickly summarise, it's essentially the band getting back together on this company from a previous investment which we held, which was very successful, called Acrux. It's a pooled development fund, and as was Acrux. And when the team who ran Acrux, they IPO'd it for $70 million. They ran it till it had a market cap of $700 million. And they generated approximately $250 million worth of dividends during that time. It's the same team that are now involved in this vehicle. It's in medical supplies and distribution. FY19, Yes, we've seen the share price correction there, but what happened was they made a key acquisition, raised some money, and we've seen the benefit of that flow through into FY20. There's a long pipeline of growth opportunities for this business in Australia. Thirdly, Enero. It's been our core holding since day one of this vehicle and across the NAOS business. It's had a great FY19, as you can see there. It's our group of marketing and PR companies. FY19's performance was pretty much driven by their growth in the US market. They've got some key PR assets there that grew approximately 3 times their profit throughout FY19, and pleasingly we've seen that continue into FY20. The balance sheet's under-geared, and we feel they've got plenty of ample opportunity and capacity to be able to grow further in the US market. Finally, CML Group, again a core holding of the NCC portfolio. FY19, the way I think about that business was there was nothing that fundamentally went wrong with it, yet what we saw was a severe liquidity restriction from the micro-cap end of the market, and CML Group were a key, had that key influence on their portfolio and their share price during that time. Pleasingly, going into FY20, they've made a key acquisition in the last couple of weeks of a business called Classic Finance Group. And what that does, it gives them scale in 2 key areas which they were only just starting to operate in, and effectively speeds up their process into new markets by approximately 2 years. It's a business that trades on a single-digit PE, has an excellent yield, and has an EPS growth profile which is very strong. So we're very happy with that being a core position going forward. Turning now to NSC, which is our small cap vehicle here. As you can see, the market cap average there is more than double what it is for NCC, so it's definitely true to label here. Key points there, the cash weighting. Again, we feel like we've found compelling investments that justify a low level of cash. We can see the profit reserves there figure, so almost 3 years worth of maintainable dividends should nothing change. I guess the key here though is the buyback. This is not a buyback to window dress. The board of directors feel that there is compelling value to actually buy back stock in the market, and whilst that exists, we're happy to do so. The fundamental reason is we hold companies that we think are undervalued within the portfolio. If we can then buy them at a discount through our own shares, we're very much happy to do so. Coming to the key holdings here, so MNF is one we've talked about a lot in the past and is a very key holding across the business for NAOS. FY19, as you can see by the share price performance there, was not a good year. And I think why we can summarise that was the market didn't understand what they did. They had a few key areas of their operations which we believe were non-core that have penalised their overall earnings profile. In FY19, I think as a group, we took a lot more of an activist role in terms of how we engage with boards and management teams around positioning their businesses for the market. And we feel we put in an awful lot of work with M&F in terms of how we can help that company transition to be a better looking optically company for the market and simplify their story and make it so that investors focus on what matters. Pleasingly, we've seen that at the FY19 financial year result, where the company really simplified their business, focused on key customers, which include companies such as Microsoft, Google, Amazon, and it's all about communications. So just as like the mining services companies, you've got picks and shovels that help out with the miners. These guys are a picks and shovels business for the telco industry. They are a software company masquerading as a telecom company. Yet the valuation on this business is as a telecom company. We believe over time it should justify a software multiple, and we feel that the management team have the pedigree to be able to get it there. I've touched on Enero, so finally on over the wire, which has been a key holding for this portfolio for quite some time. It's quite hard to get exposure to the cybersecurity theme on the ASX, and we feel we can do this through over the wire. It's got a very strong management team, and they've executed excellently on a track record of acquisitions in the IT and IT services space. So FY19 was a great year for them. What happened in FY20 so far is an acquisition they made during FY19 had somewhat of a timing issue on an earnout. We think it's simply that, a timing issue, and the underlying core business is going very well, as is that acquisition, and the pipeline is very strong. With a management team that own 50%, we're very happy to be aligned with such a business. Thirdly, coming to NAC, which is our X50 mid-cap portfolio here. Key things to highlight there, as you can see, the market cap is again subsequently double what it was in NSC. The cash weighting there So it's about 16% at last reported. There is also a position within that portfolio that has been taken over. So the underlying cash balance is actually quite a bit higher than that at the moment. We're definitely looking for ideas, and we feel like we've got a short list of investments that fit our criteria. As you can see, the dividend reserve profile there, the franked dividend profile since inception in 2014, and also the fact that we've got a buyback going. I come back to my comments earlier around being able to buy into compelling investments we think we hold at a discount to our own share price. I'll skip over M&F, and Smart Group I'll just touch on briefly. That was a business that does novated leasing and salary packaging. Business we know very well, an excellent management team and great returns on capital. Going into reporting season, we felt the market was undervaluing that business or penalising it too hard on kind of the macro issues. We took an investment there and have subsequently sold out post the re-rating as it's hit our justified valuation on that business. Thirdly, AP Eagers, which is the largest car dealership company in Australia, that's obviously going through a merger that is now subsequently finalised with AHG Group. So they'll now have approximately 11% of the market share. Yes, the automotive headline industry has been tough, but what these guys, AP Eagers, have been able to do is consolidate, and now they have 11% market share, be able to generate significant cost synergies by buying the AHG business. But what excites us the most is the revenue synergies they should be able to generate over the medium to longer term, principally around things like finance and insurance, and also the ability that they'll have in terms of free cash to be able to provide that back to shareholders. We believe over time they could have approximately 15% of their market cap in cash available to benefit shareholders through capital management decisions. So it's a business that is above market, very much above marketing quality, yet we're able to buy that at a below market price. And finally, on people infrastructure, this is a workforce management business that we've owned since the IPO, run by a very capable individual out of Brisbane. And FY19 saw them make two very key acquisitions that are both strategic and EPS accretive for shareholders. In FY20 going forward, we feel that they'll be able to realise cost synergies and revenue synergies out of those two acquisitions. And underlying that is the NDIS thematic that Sebastian touched on earlier. We think the organic business as well can continue to grow at approximately 10% or plus. So we think that business, relatively low gearing and a very capable management team in a great tailwind area. So we're happy to hold that again going forward. Coming to the outlook, we often get this, you hold 30 companies, so what do you do for the other 300 odd days of the year? We do a lot of work behind the scenes on speaking to stakeholders of businesses that we know, and often as well, we always go out and see as many companies as we can. So we've just, as I mentioned, come through reporting season. We would have seen over 100 companies throughout that period of time. We've always got companies that we're looking at or have known for a very long period of time before we're satisfied with investing. And I won't touch on too many of these here, but I'll just mention briefly Experience Co, which is a business we've known since the IPO back in 2015. It's a skydiving business. So what they do is they've basically got monopoly assets across Australia and New Zealand, great margins and a new management team because they went off stray and bought some very non-core assets. We believe the current new management team have the ability to rationalise that business and return it to what it is, which is a very good business at heart. And the existing opportunities. So often the way we invest is we have to be early a lot of the time. If you want to build up a 20% stake in a liquid business, have a relationship with the management team and know a business well, and then subsequently be able to provide growth capital in time, we have to be early. So some of the companies here, which I won't go through in too much detail, are kind of the next generation businesses that we've been able to, I guess, invest in and build up meaningful stakes over time, which we think should benefit shareholders over the next 3 to 4 year period. And coming to the bottom point there around our existing positions as well, fundamentally the reason we would sell a business is if it hits our valuation or there's been a change of strategy. And the three businesses there that we talk about, they've had a re-rate over the past little while, which in our opinion has been long overdue and justified. Saying that, the core underlying thematic in why we invested remains the same. Yes, there's been a re-rate, but we feel those businesses have got plenty more to go. And we don't invest in anything for a multiple expansion. We invest for today's earnings and the future that should hold without any sort of multiple expansion. So with that, I will hand back to Sebastian.
In regards to obviously the outlook, it's very hard for an LIC to provide any outlook, but at the same time, we try and take the view that we would expect our investee companies to provide some form of outlook as well. So I'll try and do my very best here, and that's what Rob was trying to do. I've already had a couple of questions on this, and it's amazing the different views you get. But obviously the discount to NTA and trying to address that. Clearly, we believe our investments are undervalued. I think we've done enough talking about that. With the funds potentially at 15 to 20% in the first 3 months, I think we've shown that our investment process and subsequent performance is sound. We don't need to change that. In regards to the discount though, I think these are the points that I wanted to touch on. Some may seem very simple, but I think it's worth pointing them out. Without a doubt, for whatever reason, people buy your shares and pay a market price or a premium when your performance is at your peak. Don't ask me why, that's just the case. So our LICs seem to trade at a premium when your performance is at its best. So I think the first thing we need to do is focus on performance. And I think you've seen in the NSC share price, at the very least, when performance picks up, your share price also picks up, and hopefully it should pick up more than your subsequent performance if you're trading at a discount. The other point I will touch on is, we can't deviate from our strategy and our philosophy. And the reason I will tell you is some of our largest investees, whether they're high net worths or family offices, are actually independent financial planners. They're from all over Australia, whether it's, we've got a large one in Rockhampton, for example, a large one in Adelaide. And the reason why they use NAOS LICs is because they want exposure to the smaller end of the market, whether it's micro cap or small cap. And they like the industrial, well, I suppose they like our philosophy. So it's long-term industrial, concentrated exposure. If I was to go to them and change that, they would automatically say, we've got, in one case, we've got 200 clients, we've got $30 million invested across your LICs. We would need to change that as well. So, for us to go and say, well, we're going to invest in, high growth tech stocks or whatever, go offshore or whatever it is, it'd really shoot ourselves in the foot. So it's important that we stick to our knitting and stick to what we do and do it well, even though we'll go through periods of time where we will underperform like we've just gone through. The dividend. Some people like dividends, some people hate dividends. At the end of the day, we try and do the best we can for all of our shareholders. So I think it's important that we maintain the dividend at least, and we try and inch it up over time. I think the income is important, or timely income is important, regular income is important for some people. So I think we need to continue to do that. Because I think if you go and look through the LIC universe, there are very, very few LICs that have been able to grow or maintain a dividend without going backwards at some stage in time. The buyback. I've already had a shareholder saying I would like the buyback removed. Just depends. Everyone's got a different perspective. I think Rob said it well. We use the point that at the end of the day, if we can invest in a portfolio of stocks that we think is undervalued and then invest in some cases at a 20 or 25% discount, that's a very efficient use of shareholders' capital. It doesn't mean that we think the funds are going to get smaller. It doesn't mean we feel like there aren't any opportunities out there. We just think it's I suppose a bow in your arrow to close the discount and to increase the NTA. So for every share that I can buy back at a discount and cancel means my NTA is going higher before I need to even do anything, before I need to get out of bed. So it's a good way to use shareholders' capital, and to be fair, it's one we'll continue to be aggressive with as well. The last 2 points, soft points but key. As I said, directors, family and friends. Pleasingly, my old man bought some shares the other day. In NSC, we continue to be the largest shareholders, directors, family, friends in all of the LICs. And you've seen us be quite active across all of them. And we will continue to be, because I can tell you no one hurts more than me when the share price is down. Even based on the verbal feedback. From a personal P&L point of view, it hurts a lot as well. And the last one is, marketing materials. Rob mentioned that a lot of our companies, sometimes they struggle with the way they market their process and their business and what they're trying to accomplish in the next 5-year period. It's important that we don't make that same mistake. It's important that we continue to improve, so you understand what we're doing, why we're doing it. And when we do get things wrong, you understand why we made those decisions. But at the same time, when we get things right, you understand why we made those decisions, what the process was, and what you're getting, I suppose, at the end of the day when you get exposure to any 3 of our LICs. So hopefully you can go away, tell some of your friends. We can say, I had a good experience from this NAOS LIC, and I understand what it's trying to do and what sort of, I suppose, service it's trying to provide. So to finish off, somewhat of an outlook. What we can do is, and I always finish with this slide, is we just focus on things we can control. We invest in proven management teams and proven businesses that have been around in most cases for many years. They should have earnings, they should have balance sheet flexibility, they focus on a core competency, they should be ESG aware, and they should be very much aligned with shareholders. And hopefully over the longer term, they should grow significantly, even though they may not look like it today. That's what we can control. Overlaying that, I think it's without a doubt we're playing a much more active role in some of these businesses, whether it's board composition, transparency of marketing materials, funding in some cases as well. We want to be a lot more proactive in regards to that, because I think it's actually beneficial for the business as well. And we get a lot of positive feedback from businesses that we've helped more recently. We have management teams, they say, that feedback is invaluable because we actually don't get it from anyone else. At the end of the day, you're very much aligned with us, so we know the feedback that you're giving us does come from a good place, and you want the same outcome as us. So I think we'll continue to do that and probably even ramp it up a little bit as well. What we can't control, market noise and short-term timing movements. I know it sounds like a bit of a cop-out, but at the end of the day, when you invest in small businesses, they can move around a lot in a short space of time, as you've seen with BTC. It was up 50% one year, and then it's down 50%, but now we feel like it's a better place. Overall, though, the way I view it is we'll have 10 investments. You will have, hopefully, you have 5, 6, 7, 8 investments that perform very well over the longer term. You will have some investments that simply just don't turn out for whatever reason, but hopefully we can minimise the losses. End of the day, if you think about it, we've never had one go to zero, but if a stock can just go to zero, but if you can get one that gives you multiples of your money, like an Enero or even an M&F, for example, that will more than offset those negative returns and hopefully provide you with the 15 to 20% per annum that we're trying to do through a market cycle. But thanks again for your support and thanks for coming.